The following conversation with Dr. Stephen Elliott. Dr. Elliott specializes in the study of individual non-market valuation and decision-making under risk and uncertainty. His work utilizes experimental economic methods to address complex issues such as pollution permit markets for acid rain reduction, the strategic value of the US Petroleum Reserve, and the economic implications of biodiversity in aquatic habitats. Throughout his distinguished career, Dr. Elliott has contributed to the peer review process for esteemed journals like the American Economic Review and the Journal of Environmental Economics and Management. His insights have also enriched the National Science Foundation's economics and decision, risk, and management science programs, as well as various U.S. departments of energy models through the Energy Information Administration's Independent Expert Review Program. Dr. Elliott's commitment extends to serving on EPA grant peer review panels, focusing on incentive-based methods for pollution reduction and the interaction of pollution with health impacts. My mission, as always, to explore the world in depth from every perspective, including the rich field of economics, to better understand the complexities of our environment and our interactions within it. So I think it's good to start with the most fundamental question of this world, of everything current and of current society. So what is money? Can you describe the money and what is money and its core, and how does its nature influence the way we shape our society and individual behaviors?
Good question, and a complicated question, and not necessarily easy answered. Money is, by its nature, it has a couple fundamental characteristics. One is it's a store of value, so that $1 today is $1 tomorrow, is $1 next year, is $1 10 years from now. A dollar printed in 1950 is $1 today. So it's a store of value. It's a unit of exchange. So it's something that people are willing to accept to give up something. So fundamentally, you go to the store and you decide you want to buy an apple, and you can give them money and they will take that money. So it's an exchange. And really what it does, its fundamental importance is it allows us to have an economy where I don't have to trade my skills directly for a good. So if I'm hungry, in a world without money, if I'm hungry and I want to go get a pizza, I've got to find someone who is willing to give me a pizza for economics tutoring or math tutoring, right? And that's hard to do, right? Because what we say in economics is you have to have a double incidence of wants. Somebody has to want what I have, they have to want what I have to want what they have. And so in an economy without money, that's really hard to do. And so what we do is we create something that we all agree represents something of value. And so I get dollars or rocks or pebbles or little pieces of metal with some person's face on it. Mm-hmm. And they give that to me because I have worked. Mm-hmm. And then I can take that to the pizza person and give it to the pizza person, and they will give me the pizza, and they can give that to their supplier for the wheat and the toppings and all that stuff. So it's this generally accepted unit of exchange that everybody wants. Mm-hmm. So if I think about bitcoins, which have tried to be a form of currency or a form of money. The bottom line is I can't go get a pizza with a Bitcoin. Right? I don't think SDS Pizza is going to take a Bitcoin or a partial payment of a Bitcoin for a pizza. So all of a sudden a Bitcoin isn't money. Right? Gold isn't money. Because gold, if I go to SDS Pizza to try to get a pizza and I try to shave off a little bit of gold off of my little gold bar, $12 worth of gold off of my $2,000 gold bar, they're not going to be very happy because they can't take it to their suppliers and use it. So that's why money is important. Now, what gives money its value is nothing. Is our belief that it's valuable, that someone else will take it. So in the United States and almost the entire world, there is no currency that's backed by gold or silver or any precious metal. Why is a dollar worth $1? It's because we believe it's worth $1.
Yeah. So money is piece of information which everybody believes and everybody accepts, and that way it works.
It works. It works because we believe it does and we want it to, which is at times unnerving. Well, and so what happens is once people believe that your money isn't really worth what you say it is, then they don't want it anymore, and then it's not money anymore. So you get situations like Zaire where nobody wanted their Zaire dollars. So in order to buy anything with Zaire, in Zaire, you either had to have US dollars or you had to have billions of Zaire dollars because nobody wanted them. They'd printed so many of them, nobody wanted them.
Yeah, it's interesting. I guess situations also work with stock market. So people believe that this kind of stock has a value, and after some situation, after something happened, they stop to believe that
I mean, it's somewhat different because a dollar is a dollar, right? And again, can I go to SDS Pizza and buy a pizza with Apple stock? No, right? Now, Apple stock has value. What I haven't looked at the value of Apple recently, but and somebody will buy it from me, so I can turn it into money. And yes, information is hugely important in equities, right? But less so with money. A dollar is a dollar is a dollar.
I see. People.
Well, and remember that most of money is not paper, it's not coins. Currency is a really, really small percentage of money. Money is zeros and ones. It's the number in the ledger of the bank with your account. And that's nothing physical. That's the bank's records of how many dollars you have. So most of money is on paper. I mean, not paper itself, but actually just in a computer.
It's just like a value, just like in numbers. So people just believe that they have that amount of money in their bank account, and actually they will have it because it's on a paper.
Well, and the banks work. I mean, the banks and the government work very hard to assure us that where we have our money will not disappear. So banks are highly regulated because they're really the foundation of money.
Okay.
They're where money creation and destruction happens. That's how we grow the money supply and we shrink the money supplies through banks.
We will dive deeper into the banks. I will ask a couple questions about that. And I guess another fundamental question is, what is economics? What actually it is?
Well, I mean, economics is a social science. So some might call it, and I have on occasion, the religion of business.
Okay.
We are the keepers of the dogma. But really what it boils down to is a social science about choice. So if we think about how we in social science approach how people look at the world and how they organize and how they do things, economics is just one of those disciplines. The metric we use is efficiency. Are we using our resources, our time, and our talent in the most efficient manner? Not necessarily fair, but efficient. So it boils down to a lot of issues in decision making. So at its heart, economics and psychology have a lot in common. So, economists and a number of people who have won Nobel Prizes in economics have been psychologists because they're looking at how people make decisions.
Yeah, it's overall decisions of people making. So, can you tell me more about the influence of economics to the daily life decisions?
Well, I think as I look at economics and as I talk about it in Principles of Micro, if we look at the question, as an economist, I can look at any question and it becomes an economic question. Why is it you and I are sitting here? Well, you have a want to talk to people about these ideas. I am happy to do that. We have made an economic decision about how to use our time. If you take an 8 a.m. class where you would prefer to take a 10 a.m. class, it's an economic decision. You have made that decision. You have decided there is a reason that you want to be there at 8, even though you would prefer to be there at 10. It's trade-offs. Economics is about trade-offs. We can't have everything, so how do we get what we want to be as happy as we can? And, whether or not that deals with money, it's not about making money, it's not about making profit, it's not about, fundamentally about how businesses are structured. All of that's in there. But so is your decision to come to Miami University is an economic decision, and not just because of how much money it costs.
It's overall economic decision, including opportunity costs of me choosing other universities.
Exactly.
And including my time management. I think getting to the university is a better choice for me at the current position because it grows my value.
Well, that is certainly one way to talk about it. I would say it more fundamentally, which is you chose to come here because it made you best off. Now, is best off defined by wealth and money? Could be. Does it have to be? No. Right? There are a lot of people who will come to Miami University because they will learn the profession they want to be in. For example, teaching. And you will never, ever in your entire life get rich being a teacher. But that's what they want to do. That's what their passion is. That's what makes them the best off, and that's why they pursue it. And it's not about being wealthy. It's not about having, the penthouse on 57th Street. It is, I want the best possible life, and what decisions do I have to make to do that? So, and very broadly defined as anything, money might be part of it, money might not.
It's like current billionaires in the world, people think that why they don't have like houses, why they don't have like billions of cars, why they don't do that. So it means it's the their position is best stuff for them.
We assume in economics that people are rational, so that they do what they believe will make them best off. If they want to work 20 hours a day, cool, right? But that is not necessarily what everybody wants to do.
Yeah.
So you hear about people who go, well, I was in my job as a CEO and I was making millions, and I was working and I realized that I hadn't seen my kids in 2 years. So, I'm leaving that position so that I can go spend time with my kids. So I'm giving up all of the stuff that came with that job, including money, because my kids and my family are more important.
Yeah, so value of decisions changed.
Yeah.
Economics is shifted a little bit.
What is important to the individual has changed. And you can you can look at that in terms of value, but you might as well just be fundamental about it and say, what I think is important and the goals that are important to me are this, and that's what I want to work towards. And whether or not that's lots of money and fame and fortune, or spending time with my kids and enjoying going to the park every day, it's the same decision, just brought about by different people with different preferences. And preferences change over time. So
it's actually fascinating how how it affects the choices, and economics of choices, the management of choices is also, because usually people don't pay attention to their choices and decisions. They don't think it's economics. I just choose it because I feel good doing that, but in a deeper inside of this person, there is a economics of choices and his values and his. I think this is better than that. That's why I'm choosing. But nobody pays attention why I choose that, why I made that kind of decision, and how it influenced my life.
Well, and of course, over time, we learn about what we think is important, and maybe it continues to be important, and maybe it doesn't. Right, so lots of people are at school and come to a business school, for example, because they want to go into high finance. They want to go into investment banking. And that's for some people and not for others. Mm-hmm. And it might take going out and actually doing it to realize what it's about. And go, well, I really enjoy this. Or, dear God, I'd rather be hit by a bus than do this any longer. Right, so our preferences change and adapt as we learn about the world we live in. And that's all economics, or at least the economists will say so. It's all, it's also psychology. As I said, some of the best economists are psychologists. And some of the best models of choice theory come from psychology versus economics.
That's very interesting. So speaking about the startups.
Mm-hmm.
So startups often disrupt traditional industries by solving problems in innovative ways.
Uh-huh.
So why economic theories best explain the rise and impact of startups today's society?
Well, there's always, when we as economists look at production theory, and as we talked about in class, one of the things that's in there is technology, how we bring together resources to create a good or a service or something. And so people are always looking for a better way to do something, with the idea in many cases that I can I can do it, I can put something together faster or better or less expensive and produce a better good, and I can earn money. But there are a lot of people who for lack of a set of words that I like better, are serial entrepreneurs. They start a company, they get it up and running, and then they sell it to someone else, and then they start something new. Why? Because they like that process of starting stuff. That's the idea of being an entrepreneur, part of the idea of being an entrepreneur, right? So people who like starting stuff, getting it going, getting it up and running, making it successful, once it's successful, they're tired of it and they move on. So there are people like that. There are people that go, I'm sure I could do this better than the people who are doing it now. And so that's what they choose to do. And again, what are people doing? They are choosing what makes them happiest, what they enjoy doing, right? There is no way on God's green earth that I would do a startup. I mean, there's lots and lots of risk involved, and I am a relatively risk-averse person. Hence, I work in academics, which is, one of the safest shelters in the entire world. But there are lots of people who are risk junkies and like doing it. And so it's that spectrum of people and what they like to do that give us all the stuff that we have, including lots of startups. I mean, there are lots and lots and lots of startups all the time. And I think the statistic I saw is that 50 to 60% of them are dead in a year. Yeah. Means I tried it and I didn't like it and I got out. And there's nothing wrong with that. Not everything becomes Amazon.
Yeah. So in these days, people usually fear of failing. What if I also have so many questions about that. I have also so many discussions with my friends and about starting a startup. And the first question which arises, what will happen when we will fail? I mean, we will fail, so then how we can deal with that?
Well, I mean, I think the issue there is, if you're excited, if you know the downside risks and you know what can happen and you still want to do it, then you should. If you look at the potential downside risk and go, oh, that's way too scary. I'm really frightened of what happens if I fail, then you shouldn't do it. Right? Because it's likely, for one reason or another, that your business isn't going to go on that long. So are you willing to accept taking on lots of debt and going into bankruptcy? And lots of people are. And that's great. I'm glad. I don't. I wouldn't. Dear God, no. Right? That's just much too frightening. So, again, in economics, what we look at is the idea of risk preference. How much risk are people willing to take on? So some people are very risk-loving, and some people are very risk-averse. And there's people all the way in between. And so oftentimes we model risky decision-making. Right? There's a whole field in microeconomics on risk uncertainty and decision-making. And how do we model it and look at it?
So again, we are coming back to economics of decisions. What is best for someone? What is what they choose? What their preferences and the psychology of the person.
Yeah. I mean, and the important thing to realize is there's no steadfast rule. It's not like people born on Thursdays on even-numbered days in even-numbered months are going to be successful and willing to take on things. It's who you are, it's how you grew up, it's what interests you, right? It's not systematic. And those things can change over time.
Yeah, people usually tend to group people according to their date of birth, according to their signs.
Sure.
If I'm not mistaken. So they usually tend to take a risk according to what their science news talk about. I mean, the stars, the position of stars. I usually wonder how position of stars can affect the.
So do I. So I put very little in the idea of astrology, that where Mercury was when I was born should have little, or that I can understand would have little or no impact on my life, right? But lots of people look for some influence on their life that's outside of their system. That I'm predestined to be the way I am. And if that makes people comfortable, I'm all for it.
Yeah, they tend to find another, how to say, reasons, maybe for faults or.
Oh, yeah, no, I mean, that's. We as people like to. We want to have answers to questions that are really hard. And one of them is easy, is to say, well, gee whiz, this is where Mercury was on my birthday. And that's influencing my life. And that's out of my control. I don't know. I try to stay away from it.
Yeah.
I like nice mathematical models. But of course, people are not everywhere continuous and twice differentiable, so my models aren't all that good either. So
yeah, so we just talked about loans and startups. So I guess it would be great if we speak about the banks also, the systems, how they work, about the whole credit and loan story. What do you think about that?
I think there's an entire course called Money in Banking. So what you have asked is at least a semester's worth of information. But generally speaking, banks are the foundation of the developed economies in the world today. That without banks, the economies, without banks, the U.S. economy would crumble. So back in 2008, when you weren't paying attention to the world because you were not big, the biggest problem was that banks were looking to shut down. And they're the ones that hold all those little electronic ones and zeros that represent wealth. So when they go away, the wealth goes away. Right? If I have $10 million in Chase Bank, and Chase Bank declares bankruptcy, my $10 million are gone. Money is destroyed just that quickly. Right? And the process by which the money supply is created or destroyed or controlled is through loans. If banks loan more money, they're really creating money. The banking system works this way. It's called fractional banking. Are you familiar with fractional banking?
Not much.
So I go to the bank and I put $100 in my checking account. The bank is required to hold a certain amount of that in reserve, right? Because I'm not going to go visit my money every day. So the bank doesn't hold all the money in a vault, right? So that you can go look at it and talk to it and pet it and see it. They realize that they need to have a little of my money around in case I need it. But they don't need all of it. And so what do? They hold on to, say, $10, and they loan out $90 to someone who needs a loan for a startup. And in a very simple world, how do they give them that money? They create a new checking account and put $90 in it. So my $100 that I put in the bank has now become 100 plus 90. And then the bank says, well, they're not going to need all that $90, so why don't we hold 10% of it, and we'll loan out the other $81. So now I have $100 plus $90 plus $81 that came from the $100 that I took in. Right? We create money by loaning it out. We destroy money by calling in those loans.
That's actually very complex process.
Oh yeah.
Also, it's also very interesting, and I guess it's also believed that people think their money is still on their bank account,
Sure.
on their I don't know, some kind of like safe.
and in a sense it is. But if one were to follow out this process of creating money, if I put in $100, in theory that will create $1,000 worth of money. They can create as much as $1,000 worth of new bank accounts. And that works as long as as long as everyone doesn't want all their money at the same time. Because how much money is there? There's the $100 that I put in. There's $900 out there that is on the books and just on the ledger. Mm-hmm. If we all go to the bank on the same day and say, give me my money, they don't have the money. They have $100. And they got $1,000 worth of deposits. So this is the great fear in banking, is that they have all of these assets, the loans, and they have $900 worth of loans and $100 worth of cash. And so if anybody comes and looks for it, they don't have $1,000 worth of cash. They have $100 worth of cash. And all the rest of the money is not there. So the great fear in banking is that there'll be a run on the bank, and that's when everybody shows up at once to get their money out because they don't believe they can get their money out. And then the bank has to close because the money isn't there.
So in the real world, I guess it's more connected with security of bank, and
it's whether or not there are a few things. Do I believe that my bank is strong enough that if I really did need my money, I would be able to get it, and they'll be able to pay me. The second is that after there were runs on the bank like this in the 1930s in the Great Depression, that the banking system was very shaky, that the federal government created the Federal Deposit Insurance Corporation, so that if you're in an FDIC bank, Federal Deposit Insurance Corporation, if they have FDIC insurance, you're covered for the first $200,000 in your account. Anything more than that you could still lose, but you're covered for $200,000, which is more than most people have. So now you're not concerned about the safety of your money, and you go on with the world. But there are bank failures. There are 5 or 6 bank failures a year in the United States. And quite often the government steps in and the Federal Reserve pays, because they need the banking system to work. They need it to work. Because if it doesn't work, people don't have confidence in the banking system, everybody pulls their money out of banks, all the banks collapse. That was 2008. Was that banks were beginning to fail, and big banks were beginning to fail. Because instead of loaning the money, they were going and buying real estate. Or they were taking these loans and packaging them up and selling worthless loans so people would buy worthless. It just gets very complicated, but all the money began to disintegrate because the value of real estate fell. It almost, I mean, dear God, we lost Bears and Stearns, was one of the biggest investment banks in the world, because they had chosen to put their money in weird places, and they lost it all. And the federal government stepped in and didn't bail them out, but said, well, we're going to let them go. But they bailed out Merrill Lynch. Merrill Lynch was going under for the same reason. They were about to fail. And the federal government basically made Bank of America go in and buy Merrill Lynch and keep it alive. It was a scary time. Most people don't know it, but it was really scary.
Yeah, 2008, not that far long ago. Yeah. So, even couple banks fail, people's trust to the overall bank system will go down.
Yes.
And it will affect the whole, every bank's.
Yes.
Belief.
Yes.
It's also belief.
Yes. Yes, it's quite scary. I mean, a couple small banks like the Bank of Mom and Pop in Oxford, if it fails, it's bad, but it's not bad. Mm-hmm. Chase Bank fails, you got a huge problem. And so there's this whole area that people talk about. It's too big to fail. Big banks are too big to fail. We can't let them fail. So the government steps in and assures that they don't. Which, of course, is the social indemnification of loss. Mm-hmm. Which is this, it's to me an interesting thing, which is a lot of people are very pro open economy, perfect competition, keep the government out. But dear God, if I'm going to make a stupid financial decision, I want the government to indemnify me. I want someone to come and bail me out. Right? So socialism is a bad thing when it's given to someone else. But when it's affecting me, maybe not so bad. So the great example there, and we're getting a little far afield, but we have lots and lots of people who don't believe climate change is a problem. Mm-hmm. We look at the state of Florida, which is very conservative, very much anti-government, anti-idea of socialism, mm-hmm. which, of course, socialism just being government providing lots of goods. Mm-hmm. But because of increased sea level, increased hurricanes, increased damage, the major insurance companies in the United States, Prudential, Allstate, State Farm, won't write homeowners insurance policies in Florida. They won't touch them because they know they'll lose money. So who has to, because you have to have a house insurance in order to get a mortgage. Who insures them? Who insures all these houses in Florida that everybody's moving to? The state of Florida. So here is a governor who is anti-government, smaller government. Government needs to be out of our lives, and they're the biggest insurer in the state because no one else will do it. So I believe that's irony.
Yeah. So when you need something, it's good. When it affects somehow.
Well, of course, the other thing is that if I'm a bank, yeah. and I know that the government, the people, whoever, are not going to let me fail, mm-hmm. then I'm much more likely to make riskier decisions. Mm-hmm. So I get to profit mm-hmm. from all of the benefit of taking these big risks, knowing that I'm not responsible for the losses in case they don't go right. So I get all the upside benefit, and I have to deal with none of the downside risk. I mean, wouldn't it be nice to go to Vegas and know that every time you lost, somebody standing behind you would just cover your losses? But if you won, you got to keep the money.
That's interesting. Yeah, it is actually very interesting why government supports banks that much. Is it like very important?
It's very, very, very important. Yeah, it's fundamentally important. Yes.
And one more question about the collapse in 2008, bank system collapse. So, fortunately, I don't see any effects of this collapse, I guess. And how did even government, solved the problem with collapse, or how it was resolved?
Well, so, a lot of what happened, for example, and it was real estate based.
Mm-hmm.
And the assumption was that the value of real estate will never go down because it is limited. It's finite.
Mm-hmm.
We're not going to get more of it. So the value can't fall. And so what banks started to do was say, well, look, you want to buy a $200,000 house. We'll loan you $300,000 because the house will appreciate over time. And when you turn around and sell it, you'll get $300,000 or more, so everything will work out. Mm-hmm. So they make loans for more than the equity in the home. Mm-hmm. And then what happens is the prices fall because, for example, Las Vegas overbuilds. Now there are too many houses. The only way I'm going to sell my house is to drop the price. And then people are losing money, so the jobs are disappearing. So now I got to sell my house because I don't have a job. Mm-hmm. And so the value of the real estate goes from $200,000 down to $100,000. Mm-hmm. But it is the basis for a $300,000 loan. So I've got a $100,000 asset that is securing a $300,000 loan. There's $200,000 that ain't there anymore. So now the loan is bad. The people can't pay, so they walk away. They declare bankruptcy, and the bank forecloses on the property. Now they've got a $300,000 loan on their book, a $100,000 property that they would love to sell just for $50,000, and they got a $250,000 loss. And that affects all those other loans that are back there. Right? So all of a sudden the bank is in serious, serious trouble. And so what ends up happening is these banks have all of these bad loans. $100,000 property and a $300,000 loan. And they got to clear this off their books. And the one way you can do it, of course, is just say, we're done. Right? My assets went down from $300,000 to $100,000. I gotta take on either more liabilities. I got there's lots of stuff but none of them are good. They're all bad. And if I'm keeping my money in the bank, I'm going, well, they got a problem because they can't cover my bank account anymore because they made all these bad loans. And so what happened is the Federal Reserve stepped in and started buying all the bad loans. The Federal Reserve Bank of the United States started buying all these crappy loans and crappy assets. And that was what was called through the teens the idea of quantitative easing. They would buy $100 billion worth of bad debt off of people's books a month. And it just meant all the Federal Reserve says was take this $300,000 bad loan off your books. We'll give you $300,000 to cover it. And we'll take it. That's what they did. They're still doing it to a small degree. Yeah. They bailed the banks out. They had to. Imagine, you think of a startup, so you think of like investment banking. Imagine Goldman Sachs on the verge of bankruptcy and all the loans and all the stuff they do disappearing overnight. Wall Street would collapse.
It's like domino effect.
Oh yeah.
The federal government tries to stop the next collapse before everything will collapse.
Exactly.
So they try to put some kind of like limits.
The Federal Reserve started doing unheard of things like loaning money to corporations so that General Motors, which at the time went bankrupt, they went back. No one would loan them any more money. They couldn't pay their bills. The Federal Reserve had actually opened up their loan window, which is never open to businesses. It's only open to banks. They opened their loan window and said, we'll lend you some money. Finally, it got so bad, the federal government simply walked in and took the company. And so for 5 or so years, the U.S. federal government owned General Motors. And once they got back up and running again, the federal government sold off their stock. I think they still have a big share, but right? In order to keep General Motors alive, the federal government simply took it over.
It's like a big brother who always covers and like stops the domino effect because it will affect everybody.
It will affect everybody in this country, and since banking around the world is interconnected, it affects every bank. So that the problem that was happening in the United States was happening in Europe, was happening in Asia, was happening, it was just everywhere. It was looking bad. It was looking really bad. I wasn't really sure in 2008 and 2009 what was going to happen.
Yeah, at the same time, United States is the center of money flow, center of capital, and I guess it's the starting point of whole domino. And so if it goes wrong in the center, it will go wrong everywhere.
Well, and it doesn't necessarily even have to start in the center. Contagions like this have happened in Asia. There was the last one was it the Philippines? Thailand. Thailand had a big they had a big fund that the government was creating, where they'd taken all this government money and put it in this fund, and it disappeared. And that created ripples all through the world.
That's interesting. So if it affects everybody, even if it started from Philippines, will other countries, will other governments will help to stop that kind of domino effect if it happens in some other country?
They have to. Because once it starts to affect the United States or starts to affect the EU, then they need to have their fingers in it.